Hey folks, Josh here with Presidio Advisors. I help millennials with equity comp. And today the question that we're answering is how are my incentive stock options, my ISOs taxed? And so we're going to go through an example here, try to put a little bit more color to it. But before we do so, I want to just share with you two kind of foundational things about ISOs that I think are really important to know before we get into this. The first thing is that there is no tax on ISOs upon grant, upon vest, and there's no regular tax upon exercise. However, ISOs can trigger the alternative minimum tax upon exercise. So that is something that you need to consider. And we're going to talk a little bit more about what that actually looks like. And I'm going to show you kind of how that comes to be. The second thing that you need to know about ISOs is that unlike other types of equity compensation, so let's say RSUs or NSOs, non-qualified stock options, when you go to sell your ISOs, you will either have what's called a qualifying disposition or a disqualifying disposition. Now, what the heck does that mean? A qualifying disposition happens when on the date that you sell your shares, you must have had your ISOs granted to you at least 2 years prior to that sale date. So that's criteria number one. And you must have exercised your ISOs at least 1 year prior to the sale date. That's criteria number two. You have to meet both of those criteria in order to have a qualifying disposition. If you don't meet any or one of those criteria, you have a disqualifying disposition. Now, what's the impact of a disqualifying disposition? It simply means that you have less favorable tax rates when you go to sell your ISOs, and I will elaborate more on what that means in just a second here. So let's go ahead and take a look at our example. And for the time being, or for this example, we're going to use some made up numbers for your tax rates, for your federal and state taxes, and also capital gains rate. This is, just for educational purposes only. And then, let's assume that on March 30th of 2021, you were granted 10,000 ISOs at a strike price of $1, meaning that the fair market value or the 409A of those options on March 30th of 2021 was $1. And if we fast forward a little bit over a year to April 30th of 2022, the fair market value of each of those shares has gone up from $1 to $3. And so you decide to exercise your shares. So you're going to exercise all all 10,000 of those shares. And here's what's going to happen. So first of all, you have to purchase those shares from your company. So you're going to purchase them. You're going to purchase 10,000 at $1 a piece, meaning that you are going to owe your company $10,000 for those shares. And there are a couple other numbers that are going to be important here as well that you'll see how they impact AMT and other things in just a second. The other thing that you need to understand is that because your shares have increased in value, so they are now worth $3 versus $1, there is a spread or what's known as a bargain element of $2. That's just the difference. The $3 minus the dollar is $2. You multiply that by 10,000 shares because you exercised all 10,000 shares. You have a bargain element of $20,000. Now, this bargain element is important to understand because the bargain element is considered a positive adjustment for the AMT, and this is what could potentially trigger the alternative minimum tax. Okay, so before we dive deeper, just a real quick high-level note on what the heck is AMT or the alternative minimum tax. I'm going to go into more detail about AMT in a different video, but I think the highlights for you for this particular video is AMT, the alternative minimum tax, is actually a parallel tax system in the US. So each year when you or your accountant or TurboTax go to file your taxes, there are actually two calculations being done. One is for the standard or the regular tax. The other is for the alternative minimum tax, and you pay or you owe the greater of the two. Now, most of the inputs between the standard and regular tax and the AMT are the same. However, there are some inputs that differ. And one of the inputs that differ is the spread or the bargain element from exercising ISOs. And it differs because the bargain element is considered income for the alternative minimum tax. It is not considered income for the standard or regular tax. Now, at this point, if I have royally confused you, that is totally okay. AMT is one of the most complicated and confusing topics out there. But I think if you are to take away anything, it's that above a certain threshold, exercising ISOs in this bargain element could trigger AMT. It doesn't mean that it necessarily will, but it might. And I'm going to give you some examples of what that could look like. So I'm going to do this, and I'm going to do this. And let's actually, that's good enough. Okay, so ignore the sale details for right now. But this $20,000 bargain element is considered a positive adjustment for AMT. So we've noted that here. Now you'll see what we have here is a free window of AMT. Well, what does that mean? What am I talking about here? So I want to caveat this by saying this should only be used for educational and demonstration purposes only. There are about a million factors that could impact this quote unquote free window for AMT, whether it's capital gains or interest or 401k deductions, you name it. So every person's situation is going to be different. But generally speaking, if you are a W-2 employee, you earn about this much. This is your filing status. You take the standard deduction. You don't have any AMT recoup from previous years, that type of thing. You don't have any capital gains or interest. Your AMT free window is probably around $30,000, depending upon your income level. I've rounded down these numbers because, again, it should just be used for educational purposes only, and it could vary, drastically by person, but generally speaking, there might be about a 30,000 window. So what that means is that because we generated only $20,000 of bargain element, it is below the AMT free window that we have assumed here for this particular person. And so this means that we are not generating any AMT income. When we don't generate any AMT income, we are not generating any AMT tax incurred. Now, if the bargain element was greater, so let's just say, for example, hypothetically, the fair market value at exercise was $5, so the spread was $4. Multiply that by 10,000 shares. Now you have a bargain element of $40,000. Well, that $40,000 is above this free window, which means that you've generated $10,000 worth of AMT income. That $10,000 is then going to incur a tax rate, and so you will owe approximately $2,700 of AMT based upon this bargain element. But again, we're assuming that we don't have any AMT because the spread, the bargain element, wasn't high enough to trigger income above that free window. Okay, so hopefully that explanation is clear as mud. I am going to close this here. And now let's fast forward to August 30th of 2022. So remember, we exercised all 10,000 shares on April 30th. And then let's say on August 30th, we actually decided to sell all 10,000 shares. And we decided this for who knows, whatever reason. Your company's having a tender offer or a liquidity event. And the fair market value of the shares, the 409A price of your shares, has increased from $3 when you exercised it to $7. And so if you sell all 10,000 shares, you're going to have a gain or loss per share of $6. That's the $7 less the strike price. So $7 minus one, $6 times 10,000 shares. And you've generated 70,000 in proceeds, which means you have a gain of $60,000. Now, you'll notice here that I have listed that this is a disqualifying disposition. Remember, we talked about what a qualifying or disqualifying disposition is, and just to refresh your memory, a qualifying disposition occurs if the grant of the options occurred more than 2 years from the date of the sale, and the exercise of the options occurred more than 1 year from the date of the sale. And in this case, I'm going to go like this and show you what I've been hiding from you. We have only held the shares from exercise, basically a quarter of a year. Remember, so this is August 30th from April 30th to August 30th, and we haven't held the shares for at least 2 years from grant. So we would have had to have held these shares at least through March, well, actually, March 30th plus a day of 2023. That would have given us 2 years from grant. But we haven't hit that. So we have a disqualifying disposition. And what that means is that we are going to have taxes as such here. So the $60,000, because it's a disqualifying disposition, it's going to be taxed as ordinary income. Actually, let me scroll back up. That $20,000 is from your bargain element, and then the difference is short-term capital gains. Remember, we didn't hold these shares from exercise for at least a year, so we're going to have a short-term capital gain on these shares. So let me show you kind of what that looks like in summary here, and I'm going to move this out of the way so that you can see it. So the summary here is that we exercised our shares because remember, we had the right to buy, and we did buy those shares for $1 from the company. So that cost us $10,000 out of pocket. We did not incur any AMT. When we sold the shares for $70,000, we had a gain of $60,000, and that gain was split between ordinary income and short-term capital gains. They are taxed at the same rate, generally speaking, and so these were the taxes paid. And so if you add up the $22,200 plus the $10,000, it cost us $32,200. We had proceeds of $70,000, and so our net cash in pocket at the end of the day was $37,800. All right. So the question that you might be asking yourself now is, great that we did this example with a disqualifying disposition. What would it have looked like if I had either held my shares for longer than a year since exercise or had a totally qualifying disposition? So let me show you what that would look like here. So I'm going to expand this out. Hopefully you can still see this. All right. So scenario one is the scenario that we just walked through right now. So this whole thing is scenario one. We had a disqualifying disposition because we didn't meet the criteria for holding the shares for at least 2 years from grant to sale. We also didn't meet the criteria of holding the shares for at least 1 year from exercise to sale. So we had a disqualifying disposition for both reasons. And we therefore had ordinary income of 20,000, short-term capital gains of 40,000, and this is exactly what we just saw. So now for scenario two, let's assume that we still had a disqualifying disposition, but we held the shares for more than a year. And in that case, the example might look something like this, where this changes to April of 2021. The grant was given to us on the 30th of March. We're going to assume that there was no cliff. And so we exercised a month later on April 30th of the same year. And then we sold on August 30th of 2022. So we still didn't hit the grant date requirements of holding the shares for at least 2 years from grant, but we have held the shares for at least 1 year since exercise. That's scenario two here. We still have a disqualifying disposition. The exercise cost is the same, but now instead of having short-term capital gains on that $40,000, now we have long-term capital gains, which are taxed at a more favorable rate. And so you can see that that leads to some additional cash in your pocket from holding on to those shares for at least a year from exercise. And so in the final scenario here, let's now assume that we had a qualifying disposition. So that means that this, let's say, is August of 2023. And so now we've held the shares. The time from the date of sale to the grant is longer than 2 years, and the time from sale to the exercise is longer than at least a year. Now we have a qualifying disposition, and this is great because now we don't have any tax on ordinary income, but we do have long-term capital gains. And so you can see that the difference from these various scenarios, this is all a difference from scenario one, 18% increase from scenario one, a 27% increase in take home from scenario three from scenario one. I want to caveat all three of these situations and these scenarios, however, by saying that you shouldn't let the tax tail wag the investment dog, so to speak. And I know that's kind of goofy, but just because you can potentially gain more in tax efficiency from scenario three doesn't actually mean that it's the right strategy. And so I highly recommend that you talk to a financial planner, somebody who is uh, understanding of your situation in different equity comp scenarios to understand what might be optimal for you, especially because you might have different capacity or tolerances for taking risk. And the longer that you hold on to some of these shares, the more investment risk that you are taking. So looking at these, it's I want to make sure that you understand kind of how the taxes work. It doesn't necessarily mean that scenario 3 is better than scenario 2 and that scenario 2 is better than scenario 1. So I hope this helps in providing a high-level overview of how your ISOs are taxed. If you have any questions, you can reach out to me. I'm Josh at presidioadvisorsllc.com, or you can visit my website, which is presidioadvisorsllc.com. Thanks and take care.